How's it going, everyone? As some of you may know, Amazon recorded their Q4 2019 earnings on January 30th, 2020. The stock was up more than 10% after hours. Wow. There are a lot of metrics I can go through pretending like an analyst. Top line beating the bottom line and whatever the sidelines, who cares? All I know is that I spent $2,000 plus per month on AWS Cloud and a ton of money on Amazon products. They better be doing well. Let's talk about something more important, how to get 10x plus returns from earnings like these. That's right, we're looking at the long call options once again. Last time we briefly talked about it in this video, as one of the 8 ways to make money in the stock market. Long call option just means you're speculating that the stock will go up a certain amount within a certain time, simply bullish on it. We'll dive deeper into the metrics and the 3 main factors that can affect the returns. Welcome to Money Insiders. My one and only goal is to increase your financial literacy by 1% every video. If you're new to this channel, do consider subscribing and dropping a like to show some support. Before we start, if you're a beginner, I highly suggest that you do mock paper trading and limit your bets to an amount you can afford to lose. Stock options can be both risky and safe if you know its limitations, and that comes only with experience. Let's get going. There are 2 metrics you need to decide when purchasing a call option: the strike price and the expiration date. The strike price is usually at or above current price if you're bullish. Expiration date can be anywhere from the same day to 2 years out. I've grabbed 4 strike prices for 3 different dates as our case study. There are thousands of matchups, but let's keep it simple. For Jan 31st, 2020, I got these prices. $18.70 was the closing price for the previous day. $19.63 is 5% out. $2,000 is 7% out. $2,057 is 10% out. Similarly, we have April 2020 and Jan 2021 for various prices. I've drawn up a table with these values so we can compare them all at once. The prices $33.64, $5.42, $2.76, etc. They're the price for the contract, and one contract represents 100 shares of the stock, so the actual cost of the contracts are multiplied by 100. Therefore, it's $33.64, $5.42, and $2.76 per contract. Looking at the table, of course we tend to gravitate towards the largest number, 23.42%. If we put in $1,000, we could have gotten $23,420. We would have needed to put in $200,000 plus on Amazon stocks to get the same effect. And who has that type of money? Can you see the power of the long option? It's made for home runs like these. There are 3 main takeaways from this summary. Number 1. Wake up early, don't be greedy. Market opens at 6:30 AM PST or 9:30 AM EST. In the Jan 31st, 2020 2057.5 case, the stock opened at 2051.47 and the option was at a high of 1400%. By market close, it tanked all the way to a penny since the stock slowly trended downwards below our strike price. You snooze, you lose, right? Number 2. As expiration dates are further away, the ROI decreases due to volatility of the stock and market, since the stock can easily tank 30% over the next year, while a closer date, Jan 31st, is pretty much locked in. Number 3. For the Jan 15/21 $1965 contract, the volume is 6. Very illiquid. It means that when you buy or sell, the spread could be quite large, shaving a few points over profits, and nobody wants that, right? Instead, look for ones with more activity so you know you'll have someone to sell to without a large spread. For example, Jan 15/21 $2,200. You see 773 contracts changing hands. Pro tip. People tend to like round numbers, thousands, hundreds, not fives. That concludes this Amazon case study. So what do you think? Have I increased your financial literacy by 1%? If yes, then consider subscribing, hitting the bell, and dropping a like. Otherwise, you can comment and let me know how I can create more value for you. Take care and have a good one.